Let's talk about how income taxes affect business entities and their owners, and how that in turn will affect what business entity your client will select. All right, so we already talked about these income tax basics. We have double taxation, where we have income tax at the entity level and at the owner level, and we have pass-through taxation or flow-through taxation, where we do not have taxation at the entity level, but we do have taxation at the owner level. And we said that a corporation by default has double taxation. We said that an LLC by default has pass-through taxation. And we said that a partnership by default also has pass-through taxation. Let's look at an illustration to help us better understand double taxation. So in our illustration, our company makes a profit of $300,000 before income taxes. And let's assume, for the purposes of this illustration only, that our company is in a 35% tax bracket, which means the company would have to pay $105,000 in income taxes. This leaves the company with a net profit after taxes of $195,000. Now let's assume that the company distributes that entire $195,000 in profits to the owners. The owners would have to pay tax on that distribution. Now that distribution is typically called a dividend. Dividend taxes are around 15%. It really depends on several factors, but let's, for the purposes of this illustration, assume that the taxes the owners will pay on the distribution is 15%, and therefore the owners pay $29,250 in income taxes. That means the net cash left to the owners after paying taxes on that distribution is $167,750. $167,750. There we go, I said it right. So you can see the difference. If you look at the green at the top, our company's profits before taxes were $300,000, and then after two levels of taxation, taxation at the entity level and then taxation at the owner level, left the owners with only a net of $167,000 and change. All right, now let's take a look at pass-through taxation in a little bit more detail by looking at an illustration. So in this illustration, just like in our previous illustration, the company's profits pre-tax are $300,000. Now remember, with pass-through taxation, we do not have any income tax at this level. The company will not pay income tax on its profits, but the owners will pay income tax on the company's profits, and will pay them not at the dividend rate of 15%, but they'll pay them at whatever regular income rate they get taxed on. So in this case, we'll assume that our owners are in a 25% tax bracket, and therefore they will pay 25% on $300,000. The owners will pay $75,000 in income tax, which means the net cash to owners in this pass-through paradigm is $225,000. Let's compare double taxation and pass-through taxation side by side. So in our example, our company's profits were $300,000 before taxes. If our company is taxed at a 35% rate, then the company's income taxes are $105,000, and the company's net profit after taxes $195,000. In double taxation, we have income taxation at the entity level. The company must pay taxes on its profits. In the pass-through taxation regime, the company's profits pre-tax are $300,000, and the company pays no income taxes at this level. In the double taxation in the double taxation regime, when the company distributes the profits to the owners then have to pay taxes on those distributions. So let's say that our owners will pay 15% on these distributions. 15% is generally the dividend tax rate. Might be a little bit different depending on who you are and what type of investment, but let's just say 15%. So our owners will have to pay over $29,000 in taxes on the dividend or distribution they receive from the company. Then that leaves the owners with $167,750. So the company's profits pre-taxes were $300,000, and then the two levels of taxation took out almost $135,000 from those original company's profits, which results in net cash to owners of only $167,000 and change. In the pass-through taxation regime, we wouldn't be paying tax at the company level. The owners would be paying tax on the company's profits, whether or not the company actually made a distribution, mind you. And they would not be paying taxes based on the dividend tax rate of 15%. The owners would be paying tax on the income based on their income tax bracket. So let's say that our owners are in an income tax bracket of 25%. That means they would be paying $75,000 in taxes, which means the net cash to owners after the income taxes would be $225,000. So at least in this example with these assumptions, pass-through taxation saves the owners a lot of money. Let's talk about pass-through losses. Now, pass-through taxation not only means pass-through profits, it also means pass-through losses. Pass-through profits, of course, mean that the entity does not pay tax on its profits. These profits pass through to the owners for tax purposes, and the owners will pay tax on the entity's profits. The same thing happens with the entity's losses. The entity's losses, since the entity is paying no tax on its losses, paying no tax, period, the losses will pass through to the owners, and the owners can then use those losses to reduce their income, which will reduce their overall tax burden. So a pass-through taxation regime, the company's losses will pass through to the owners for tax purposes only. It's not like the owners lose their limited liability if they have that. The losses pass through to the owners for tax purposes, which means the losses will be used by the owners to reduce their income, which will naturally then reduce their income tax obligation. All right, let's talk about how taxation affects undistributed profits. Now, when a company makes profits, it can either distribute these profits or some of these profits, all or some of these profits, to its owners, or it can retain these profits. Remember, we talked about retained earnings. Earnings is just another word for profits. We talked about there are three ways for a company to finance its projects. One, it could issue equity securities. Two, it could issue debt securities or take on other borrowings. Or it could retain its earnings, keep its profits that it makes, and reinvest those into the company's business. So a company can either distribute its profits to its owners or retain those profits. Now, in a double taxation regime, the owners will only pay tax on actual distribution. So if the company did not make a distribution to me, I do not have to pay any income taxes. In a pass-through taxation regime, however, the owners are obligated to pay taxes on the company's profits whether or not the company actually distributes those profits to the owners. So if you don't receive a distribution from the company, you are still liable for taxes, and you must find some other source of income to pay those taxes. Maybe you can pay them out of your savings or something like that. This can create issues for owners in a closely held business. Here's an illustration. Imagine the company's profits are $300,000 in a pass-through taxation company. Company does not make a distribution to the owners. Now let's assume that I'm one of these owners and I have a 40% equity interest. I'm one of the owners and I have a 40% interest in the business entity. This means I am responsible for paying income tax on $120,000. How much tax I have to pay would depend on my tax bracket, but I have to pay income tax on $120,000 in income, even though I actually received no cash. This is something you have to consider when structuring a business entity for your client. Let's talk about the zero-out tax strategy. This is a double taxation strategy. This is a strategy for a company that is taxed under double taxation, where the entity pays taxes and the owners pay tax on any distribution. The goal is to make the company's taxable profits zero. Make it so that the company has zero entity level taxation because the company has zero taxable income. Here's an illustration. Imagine our company has sales, revenues, that's not income, that's revenues of $400,000, and the company has expenses of $200,000, which means the company would roughly have profits of about $200,000. But we want to zero this out. We don't want to have a company that has profits of $200,000 because we don't want any taxation at the entity level. So we need to have a company with taxable income of zero. How can we accomplish this? Well, imagine we have two owners of this company, and we give a salary to owner A. Owner A works for the company. So instead of making a distribution to owner, as an owner, we give owner a salary of $100,000. And we also have another owner of the company, owner B. And the same thing, instead of making a distribution to owner, we give owner B a salary. Salaries are deductible expenses. They're like any other of the company's expenses, electricity, rent, whatever. So our company's revenue of $400,000, our company has various expenses of $200,000 plus salary expenses of another $200,000, which means our company's profits are zero. If our company's profits are zero, our company pays no taxes at the entity level. What about our owners? Well, our owners receive the cash that they want from the business. They each receive $100,000, but they receive it in the form of salary. Now, they have to pay income tax on this, but the entity did not have to pay taxes, so the overall tax burden is reduced. Now, is this a good strategy? Well, it really depends on the tax bracket of the owners and the tax bracket of the company. But this is the zero-out tax strategy. All right, let's talk about how income tax affects entity selection. The basics are that the corporation is subject to double taxation as a default. You can get pass-through taxation with a corporation if it qualifies as an s-corp. And we'll talk about the requirements of an s-corp in a little bit. An LLC gets pass-through taxation as a default. Now, the LLC may elect double taxation. And once again, you might say, why would a corporation elect double taxation? Well, the tax brackets matter, and it depends on the tax brackets of the owner, the tax brackets of the LLC, how much money the LLC is going to make, how much money the owners make, and a little calculation might show that a double taxation regime might be more favorable. We'll start out assuming that parties would like to avoid a double taxation regime. So the LLC in that situation is a good choice because it gets pass-through taxation as a default. The partnership is similar to the LLC. It gets pass-through taxation as a default, and it may elect double taxation if it so chooses. Now, that was kind of the easy version of that, but we have to look at how the Internal Revenue Code talks about this. And the Internal Revenue Code doesn't talk about corporate taxation and LLC taxation and partnership taxation. They talk about sub C taxation and subchapter K taxation and subchapter S taxation. So you just have to learn these terms and understand what they mean. Subchapter C taxation means double taxation, and the corporation by default is taxed under subchapter C. Subchapter K means pass-through taxation. It's sometimes referred to as partnership taxation. Under subchapter K, we have partnership and we have the LLC. So subchapter C, corporation, double taxation. Subchapter K, partnership and LLC, and that is pass-through taxation. The final subchapter that you need to know is subchapter S. It is pass-through taxation for a corporation or an LLC, but only if you elect it and you qualify. There are certain qualifications. Let's talk about those qualifications. All right, so what type of qualifications do you need to qualify for subchapter S pass-through taxation? Remember, we said a corporation by default has double taxation, but corporation might qualify for pass-through taxation if it meets these 5 qualifications. 1, it has to be a domestic corporation or an LLC. It has to have 100 or fewer shareholders or members. All shareholders or members must be natural persons. So you can't have a legal person as a shareholder. There are some exceptions. All shareholders or members must be U.S. citizens or resident aliens. I'm not exactly sure why we have this qualification. And number 5, all outstanding shares or membership interests must have the same economic rights. Remember, we talked about shares, stock, any type of equity or ownership interest will have control rights and economic rights. Well, if you want to qualify for subchapter S taxation, your ownership interests must all have the same economic rights. They can have different control rights, different voting rights, but they must have the same economic rights. Now, why do we have these qualifications for a corporation? Why can't a corporation just elect to be taxed as a pass-through entity? I'm not exactly sure, and no one has ever been able to give me a good explanation, but it's just something you have to remember. So for subchapter S, if you're a corporation, you want pass-through taxation, you can get it through subchapter S. If you elect subchapter S and you meet these 5 qualifications. Now, an LLC automatically gets subchapter K pass-through taxation, but an LLC can qualify for subchapter S pass-through taxation. And you might say, what's the difference between subchapter K and subchapter S? Well, there are some minor differences. We're not going to get into the details of some of the differences, but some of the differences we'll talk in a little bit more detail as we move along. All right, let's talk about subchapter K versus subchapter S. Remember, both subchapter K and subchapter S have pass-through taxation. What is the difference between subchapter K pass-through taxation and subchapter S pass-through taxation? Remember, we talked about pass-through taxation. You can pass through losses. If you're an owner and the business entity suffers a loss, those losses pass through to you, and that means you can reduce your taxable income and pay less in taxes. Both subchapter K and subchapter S have pass-through losses. But there are some differences in what type of losses and how much in losses you can pass through. We will not talk about that in detail. Just remember, if you are talking with your client's tax advisor and you need to have an intelligent conversation about what business entity and what taxation status, Subchapter S or Subchapter K, is best for your client, you know that that tax advisor is going to consider how pass-through losses will affect your client and how the difference of Subchapter K and Subchapter S, the treatment of pass-through losses will affect your client. The next topic is self-employment taxes. Subchapter K and Subchapter S treat self-employment taxes a little bit differently. And I know you're saying, well, what does that mean, self-employment taxes, and how is Subchapter K different from Subchapter S? We're going to discuss that in a little bit more detail.